Still working on that. Very warm welcome, everyone. This is the tutorial for Chinese equity markets tutorial. This is the fifth session, number 5. We're meeting for the 5th time. Let me just quickly run by you some simple housekeeping stuff. I was actually hoping to talk about bonus issues and really talk about some really interesting funny cases to show you. But we might have to do that next time. Today I want to hold some action on this instruction and the action to go to the assignment on YouTube. If you'd like to have with that. Just to let you know, so there is now a second assignment that we have given out. You guys all saw that, right? And today we are here. Now, as you know, this file is already on Blackboard, and all these actually are hyperlinks that you can click on. And when you click on it, it will take you to a particular tutorial session that you are welcome to review. If you want. This one is on YouTube, actually. Okay, so you can do that. And I think today's session, I might also just do that. So this is just highlight 12th of October. This is not a hyperlink. The one above it is. Okay, this one is, and probably today. Now, what's new? So the next lecture is going to be October 26th. So this Saturday, we don't have to have a class. I know that Paul talks a long time. We give you full value for money. Maybe about 3.5 hours sometimes, but here's your reward. So you can call it that. This Saturday, there's no lecture, and also this Saturday I'm not here, or even Wednesday. So it's basically a week off for you guys. The next lecture is on October 26th, and for you guys who normally come on Saturday morning, we will do so. We will reconvene on Saturday morning in WMY on the 26th of August. All you need to do is just follow this timetable, okay? It's still correct. So the next time we meet, in other words, is not this coming Saturday morning, but the next Saturday morning. And that Saturday is also the Saturday when you will see Paul again. Okay? Yeah, everyone happy? What else? Yeah, you now have a second take-home assignment, so have a look at that. And then no tutorials in the coming Saturday. Let me go to assignment number 1. And I always enjoy these sessions because it brings out a lot of interesting points that may have escaped you when you are just looking at the lecture notes or thinking about this yourself. And now, many of the questions actually are just kind of fact-finding. And I would prefer actually to focus, if I may, questions 41 to 44, and if we have time, possibly 47 or even 48. You can ask me questions on anything else that you want to. If there's something that you are not clear, but otherwise, I will go through these, and if we have time, I'll come back to the true/false answers. Well, do you guys have any questions on this at the moment? Everyone is quite happy with the first section. I don't mind telling you that your final exam, the style will be quite similar. to what you're doing. So we're really just getting you ready. Although I think it wouldn't be so easy. Okay? This was easy, right? Right, now, let me, so we'll take a look at this, and if we have time, we will revisit. Look, the first part is a lot easier, but still, you might have queries, and if you do, I will do my best to answer it. Okay. Now, question 41. And some of you, when you got the wrong answer, maybe even the first section, you don't know why you got the wrong answer. So it is, I'd be happy for you to ask me. So here, what do we have? Consider an IPO in Bermuda, okay, not IPO in Bermuda, IPO in Bermuda Incorporated Entity, BERCO, which comprises 1.4 billion new shares and 400 million secondary shares. So now you know exactly what this means, okay? Which is why I spent a lot of time explaining to you. So now everybody should know that a company, from the day it was incorporated, you will have shares, you will have equity, and presumably you have some debt and assets. And then when your company starts growing and growing and growing, and you make a lot of money, so the asset base grows and the equity holders get to keep that. And then what? And then you do an IPO, you get even more money now. What's going on here? Someone has hijacked my machine. I didn't do anything. Hold on a second. Okay. Where was I? Yes. So now your company is growing and you want to do the IPO, and what happened there? Sorry, this wasn't me. Okay, let me just get out and come back. I don't know why it's doing this. I don't know why it's acting up like that. So you have a company and it's already running. So when you do an IPO, you have a choice of either selling a little part of your company, or you can actually issue new shares and then you get some new capital. Everyone is now happy with that, right? That is the difference between primary shares and secondary shares. And I can see that immediately before I even read further. We are talking 1.4 billion new shares and 400 million secondary shares. So the total IPO size is 1.8 billion. Suppose there were 5.5 billion shares in BERCO prior to the IPO. So this 5.5 billion would include this 400 million, but exclude this because these are new. Assume founding investor MOG holds 75%, which is this amount, and European venture fund investor, good morning, holding the remaining quarter, which is 1,375 million. Note that MOG and EVCF each sell 300 and 100 million shares respectively in the secondary offer. In addition, the overall IPO is subject to 15% over allocation. Now, I don't know if I actually mentioned this. I will do it now just to clarify, because I might have confused you before. When there is an IPO, and you know how initially, so let's say there are a billion shares on offer, okay, a billion shares on offer. So at the start, you are splitting it 90-10, aren't you? So 90% institutional and 10% retail. I mean, never mind the cornerstone and all those, okay? So I'm not even thinking of that. So 90% institutional, 10% retail at the very beginning, yeah? Now, but there is the over allocation, which will be typically 15%, which is 150 million. Where is that actually sold to on the first day, on the actual IPO day? Where does that 150 million go? That's my question. You know? Very good. Yes, exactly. So thank you for that. So the international tranche ends up actually getting 900 plus 150. Okay, so that's how you will calculate that. I actually thought it was pro rata between the international and the retail, but actually it isn't. Okay, so it all goes to the institutional. So what's the question? What percentage of Berkeley's equity voting rights would MOG maintain or retain after the IPO? Now, here it is a very simple question, and all you got to do is okay, here's the thing. So notice there's a little funny looking symbol there, which refers to a little footnote at the bottom. One piece of advice when you are doing course assignments and what you do in that part of that is when you see a footnote, please read it. Quite often, you actually cannot answer the question without reading it. So I know, we have habits, and we are reading documents. Sometimes when there's a footnote, there's a footnote. Okay, I'll read it later. Okay, here you are. You have to read the footnote, otherwise you either get the wrong answer. What's the footnote? So the skill is full exercise of the issue. So the skill that, in fact, all the over-allocated shares will actually be issued eventually. How much is that? Well, it is 15% of the IPO size, which is 1,800. It's not 15% of the new shares, okay? 15% of the IPO, the total IPO size. So that amounts to 270 million. That's where this number came from, okay? 270 million. Now, with a question like this, my first tip for you is you have to work out the total number. Okay, I wrote it down here. New total number of shares, which is the old number plus new shares plus over allocation. Okay, And in fact, Paul made it quite obvious here. Note that full exercise of the greenshoe means Berkel will need to issue 270. So, he made that clear. So that's where that came from. So this is the new total number of shares. My tip for you is, the model of question, you will need to determine how the number of shares change from the to the new number. And not only that, you're going to be using that number of times a little later on, further down. So if you get that number wrong, a lot of your answers will be wrong. Okay, so think about that. And then the other thing, of course, is how many on the on top, the numerator, how many shares has MOG actually lost? Well, this is what they had, and they sold 300. So that is that's the answer. Okay. These questions are not hard. They just need you to have a very, very clear mind, okay, of what to do. Okay. I'm really struggling with my computer this morning. I don't know why it's acting up like this. Okay, now, so part B, given a final price of $3.20 per share, that's the IPO price, okay, compute the gross funding generated by Berkel or MOG EVCF. Okay. Here, I think sometimes the term gross funding can be a bit misleading, but in the end, what it means is just the cash flows that are generated. And you simply multiply the number of shares by, so this will be the total new shares being issued by the share price. Okay, so that part is not hard. This money does not go into the company's profit. Where does that money actually go? $960 million. Energy. From the company's point of view, they haven't made, or they haven't received, or they haven't paid a single dollar. For them, there's no impact. It's just change of ownership. Same for this one. In relation to all of the above, calculate Berkel's market capitalization value at the close of the 20th day. So that would be when the stabilization period finishes, I guess. Given a share price of $4 at the time, well, look, like I said to you, in fact, this, which you saw in part A, has reappeared. So you can actually recycle that number and use it. And if you got it right at the beginning, then you will get it right here. Okay, so it's very important. Now, 42, so in relation to 41 above, suppose the book value of Berkel's net assets just prior to the IPO is $9.22 billion, then that's before the IPO, okay? Try to work out Berkel's price to book ratio as based on the company's net assets position after the full greenshoe, which is to say after the IPO and the full greenshoe. Now, there's a little star here, so let's check that out. So it says here, assume the price to book less Berkel market capital capitalization based on the stock's closing secondary market price of $4 per share. And further assume the total number of shares outstanding after full ratio exercise and net proceeds will be 95% of the relevant gross proceeds. Now, without this information here, you can't actually do this thing, because what you need is, okay, here's before and after situation. Before this company, before all the money came through the door, this company was worth 9.22. And then after the IPO, so this is the amount of new money that is raised. 1,670 is equal to, as you must realize by now, 1,400 plus 270. So you multiply that by the IPO share price, that's the amount of money that's come in. However, 5% have gone to all the brokers and lead managers and iBanks. So you actually only get to keep 95% of the proceeds. That's what this 0.95 is doing here. Okay, so you add all that, that should equal to the book value of your company. But then the price is equal to 28,000 or 28.68 billion, which came from this valuation here. Okay, is everyone okay with that? All right, that's good. All right, left off. Okay, so the question is, when you are doing an IPO and there is, for example, here the company is selling 400 million of old shares and then issuing 2 billion of new shares. So the total issue size would be, primary plus secondary would be 2.4 billion. There will be an over allocation of 15%. Now, up to now, we haven't actually said that where would these shares come from eventually. Now, they can come from just issuance of new shares. That's one possibility. There is no rule saying it must, or they can come from an additional sale of existing shareholders' ownership. So either one would be possible. Now, the point here is, so your question is, why do we care who is doing it? We care because investors are very, very sensitive when they see an existing owner selling or selling more, or they immediately start thinking, do you know something I don't know? And why are you selling? And why are you kind of, silently or pretend that other people don't realize? And I think that was the point that Paul was making. Is trying to quietly, so you got all the prospectus. Okay, 2 million new shares, 400 secondary offer, total size, greenshoe. And I think sometimes you have to look quite hard until you find out who is actually behind, the over allocation supply. And you do care who is doing it, because if it is a company issuing, that means not only the company is issuing 2 billion new shares, they welcome more new capital. Whereas if it's the owner selling, well, in the case of the example that I made here, then the over allocation, these shares, is in fact it is almost comparable. It is comparable. You can compare it with the secondary offer that they were planning. They were planning 400, and now it's almost double. You see what I mean? Okay. Just using these numbers as an illustration. Do you understand what I'm saying? If this was a real case, then they're not really potentially only selling 400. Potentially they end up selling 760. 400 plus 360. So investors care. They do care. They care because they want to know why you're doing that, and why are you so trying to cash out in a hurry. Have I answered your question? You sure? Huh? Whenever a major shareholder is selling, people start to wonder. The opposite also can happen, by the way. When they see a major shareholder buying their own shares, they think, yeah, well, that means they're probably showing some confidence in the company. All right. Okay, where were we? Yeah, so the price to book is around it's around 2 times. Yes, sir. Sure. Yes, of course it will. Doesn't say anything about it. It will, but how does it affect? Well, well, the price is the price. The price is equal to 28680. So that doesn't change because that is just the total number of shares multiplied by the share price. But the intangible does not affect that. But the intangibles potentially can affect your full value. I'll tell you why they don't go back to that level of detail. Because the purpose of this question is to test you in a simplified way whether you understand how to calculate price to book. So we start introducing all those concepts and just becomes a mess. I'll take your point. They are forced to. Yeah, they might lose their shares. Yes, yes. It's unfair for the shareholders because they might lose their shares. You over allocate, and then okay, did you hear that question? I hope I heard you correctly. Well, I understand you correctly. He's saying that if you over allocate, the existing shareholders are the ones who have to supply those shares, then they are forced to lose those shares. Is that your question? Did you he thinks that's unfair. It's not unfair, I tell you why, because they are doing it because they want to. It is an agreement. They have to agree to it. The shareholders, the existing shareholders are happy, are willing, are prepared, they gave the consent. They want that to happen. If they don't, so it's not a case of forcing them, okay, you give us the shares. If they don't want to, then the company, and in fact, it will be, I don't know if you're thinking, okay, there are 4 major shareholders in the company. 1, 2, 3, 4. Okay, each of them give me some shares. No, it's not like that. So maybe only 1, maybe only 2. So maybe only 3, okay, who is going to give how many? So there's an agreement. There's an agreement. Can I give you one of these? No? Okay, I will in a moment. Okay, I think that one is done. What's next? Suppose Berkeley's price to earnings as of the 20th day is 16 times. Note that this ratio reflects Berkeley's prevailing share price, so the current share price, and the number of ordinary shares outstanding in the company after greenshoe exercise. Accordingly, compute the company's net profit at its financial year end. Now here, again, this little footnote here is important because it clarifies that the relevant PE ratio that you need is actually, it involves the current P, but the E is from the previous end of the previous financial year, or the net profit. So you just set up the equation, 16 times equals P. So this is a kind of EPS, I guess, earnings per share, or net profit per share, divided by 7,170. You see this number, like I said to you, crops up everywhere. So the first time it came up, in fact, was here, and then it is reused here, which allows you to get this number, which is then used here, and then this number is now used. This number is now recycled right here. So Paul doesn't actually bother to write down 5150 plus 5500 plus this plus that. He just used that number directly. But anyway, so you can solve for the net profit, which is around $1.8 billion. I think these questions are quite fun. You really learn something, how to tabulate profits and analyze company balance sheets and capital movements and so on. Okay, so 43, let's take a look at that. In accordance with the SSR reform, so suppose state controlling investor wants to convert the non-tradable stock holding of 2.4 billion into tradable A share. STG holds its non-tradable A in joint stock enterprise, CNH. Suppose just prior to the announcement, CNH has 4.5 billion shares outstanding, and CNH also has an ADR program, which relevant ADS shares listed in New York. Yeah, this was when someone last time asked me the question, where are those ADR shares? Why don't you add some more here? But anyway, now, so 4.5 billion, in fact, if you add up these numbers, they add up to 4.5. So what is happening? I'll tell you what is happening. So there are 1.1 billion tradable H shares, 1 billion tradable A, and 2.4 billion non-tradable A. Now, this exercise of split share reform, where they convert or redesignate, if you want, or redefine non-tradable A into tradable A, in the end, it is, when you think about it, it is just a legal exercise of doing this. Doing what? Doing this. Wiping out the NON part. It does not mean that the company will suddenly start dumping shares into the market. In fact, they definitely did not do that. As we mentioned a few times. So it is the legal documentation exercise of saying, okay, from now on, these shares are at least technically tradable by definition. It doesn't mean we'll sell them, but before they were not even tradable. Is everyone okay with that point? Everyone understands what I'm saying? Yeah. So it really is just like me wiping out that NON part. Okay. To gain support for the proposal, STG will compensate existing tradable A shareholders with 2.75 shares for every tradable A. So that means some shares will be reallocated from here into here. Okay? That's all there is to it. In fact, I'll tell you right now how much is allocated. Precisely 275 million. Well, that part is easy, because for every 10, you get 2.75. So for a billion, you must be getting, oops, you must be getting, you must be getting 275 million, okay? The place of incorporation of the entity, Mainland PLC, that's easy. What else? The number of tradable H, well, that doesn't change. There's a little footnote. I wonder what that says. Assume more than 2/3 of the tradable A shares vote support the reform proposal based on the controller's compensation offer of 2.75 for 10, fine. The compensation shares offered are from his own shareholding. That's what I just told you. The shares after the redesignation or conversion is subject to a trading moratorium. You do know what that word means, right? A moratorium is a kind of government official declaration that I'm going to do something or I'm not going to do something. So I promise you, with a moratorium, that I will not sell these shares for 18 months, even though technically I am able to. Moratorium. What does it mean? A temporary prohibition of an activity. Okay, that's what that word means. What else? Sorry? They are tradable technically, but the moratorium means I have converted them. I can trade them, but I will that part is a little bit confusing, which is why when you see for question C, I added something. The number of trade locations, I added a little comment. Effective public service. You see that? Because when I read the question, I thought, yeah, exactly your question. So it is not clear. Because that part, that is in a moratorium, that would not trade. Yeah, that's exactly your question. Well, for this question, to be honest, we're not working on that. But if you were to add the other previously non-tradable, I think we're going to be excused for, I think maybe we should still give you some points for that. Yeah. Okay, so STG's percentage ownership interest in CNH. Okay, again, it's the same old trick of you have to determine the total number of shares, but this is not an IPO, so it's just 4,500. But how much have they actually lost? Well, it's just from one pocket to another pocket. So they lose this 275 as I was drawing the arrows just now up here. Okay. The percentage ownership of all ADS investors. Okay, now here's the. Do you want to know about how an ADS or how an ADR program works? You want to hear about that? Yeah? Because this was one of the questions. Now, the way it works is like this. I think this is actually helpful for you to understand. The whole idea of American Depository Receipt, which is the name of the program, and when you have a program, then you can issue ADS in different tranches or at different times. So when you start up an ADR program, then you can issue ADS under it, first of all, okay? Now, as far as I know, I think the idea was invented, I don't know if invented is the right word, but it was created by JP Morgan almost 100 years ago, when there was a company in London, in the UK, called Selfridges. They don't sell refrigerators, okay? It's a department store, it's pretty classy, and they're still running. A lot more classy than Marks and Spencer. Selfridges is a big department store chain. I don't want a map, I want the image. Sorry, just to show you. So this department store has a long history, and it was a British company. And around 100 years ago, so there are some American investors, they thought, oh, I really like this company, so how can I buy the shares? Now you have to remember, you're talking like, 100 years ago, when things were quite primitive. Okay, what's that? That's the UK, okay? This is London. This is where I'm going tonight, actually. Yeah, I'm just going on a study trip for 1 week. Okay, so this is Spain and France. We don't care about that. So on the other side, what's that? That's Manhattan. Manhattan. So JP Morgan actually came up with the idea of sitting in the middle, and they will buy Selfridges shares, and they really do. They buy from the London Stock Exchange. They buy the shares in pounds, and then they will sell not Selfridges shares, but Selfridges ADR, AD or ADS if you want, in US dollars. So the investors will pay them US dollars, and then they pay pounds. Now, a couple of interesting points. So first of all, somebody has to take the foreign exchange risk, and it is definitely not JP Morgan. In fact, it's the investor taking it. So when you are buying ADS, you are right if you are thinking that you are taking equity risk. You are also taking FX risk. Okay, that's number one. Number two, after JP Morgan actually buys these shares from London, they don't sell the shares directly, but they sell a kind of, I don't know what would be the word, sort of repackaged share certificates. So it is kind of like a derivative, if you like. These are repackaged share certificate, in fact, ADS. Okay, these ADSs are backed by the original Selfridges shares from the UK in pounds. Are you with me? Yeah, but these investors are not directly buying Selfridges shares. Now, I think it might be instructive and interesting if I actually show you an example. Let's just say HSBC. Okay, it already know, my computer knows what I'm thinking. So HSBC ADR share price, okay? And I'm going to choose a 5-day history. Now, when you look at things like that, you have to pick a period when the markets are relatively stable and boring. If markets are all over the place, the numbers will not match up. But let's say, and I'm going to compare with HSBC, Hong Kong share price. Okay. And I'm also going to use a 5-day history. And I want to have a look at okay, for example, can you see the timeline? This is last week. So Thursday, October 10th at 4 p.m. That's Hong Kong time. I don't want to pick Friday because, as I remember, on Friday there was a little bit of good news after the market closed regarding the China-US trade negotiations. You see me on why Thursday. So this is Thursday afternoon Hong Kong time. HSBC actually closed at 57.50. Okay, I'm going to write that down. So HSBC Hong Kong, it closed at 57.50. And so this was October 10. at 4 p.m. Hong Kong time. Now, what I'm now going to look at is the other screen that I showed you, which is the ADR for HSBC. So like the example I showed you on Selfridges, so things haven't really changed in 100 years. So what JP Morgan, and it doesn't have to be just JP Morgan, it can be, Morgan Stanley or Goldman Sachs. All these people are involved. So HSBC in US dollars, the ADS. Now, I now want to know the hold on a sec. Okay, I want to use this price. This is Thursday, October 10th, 9:30 a.m. But this is New York time. Okay? So that would be 9:30 p.m. in Hong Kong. In other words, this would be 5 hours after the Hong Kong market closed. And then the New York market opened. Now, as I said, on that day, markets were pretty calm. Otherwise, the price can just get up right at the beginning, right the day after. And it's very hard from there. But the HSBC ADS in New York on that day opened at 36.64. You can see that, okay? 36.64. So this is Hong Kong time, and this is, so if you use Hong Kong time here, it will be 9:30 in the evening. Now, I'm going to use an exchange rate of, let's say, 7.86, something like that. And you can see that this is Hong Kong dollars, this is US dollars. And in the case of this ADR program, one HSBC ADS shares is actually equal to 5 HSBC Hong Kong shares. Now, it's not always 5, but in this case, it is 5. So let's try and do the math. So if you multiply 57.50, that's Hong Kong dollars, by 5, and you divide that by 7.86, what do you actually get? 36.86. Okay, now you can see it's fairly close. I'm sorry I can't get the exact. It's only 20 cents away because I don't know what exchange rate would actually have applied at the time. Okay. Oh, 5.8. Oh, I'm only 6 cents out. Okay. Are you with me? Do you understand? So the point here is the ADS program by itself does not actually create any new shares. All the shares actually came from somewhere else. So in the case of Selfridges, they would have come from London. In the case of this HSBC ADR, they would have come from Hong Kong. And you can see the relationship between the two. So, but like I said, if you use the day after and look at this part, this is the opening in New York on Friday. I don't know what price to use. This is why I highlight, and then it wouldn't make a very good example because the market basically get almost $1.50. Because All right. Okay, let me get on with this one. I want to look at 44. Now, maybe you can spend time reading it. Suppose mainland Chinese entity SNCY is about to list on Hong Kong Exchange via a global offering. The IPO comprises a primary offer of 2 billion H shares at a final offer price of $10 a share, so that's $20 billion of new cash. Just prior to the offer, SNCY has 5,000 or 5.2 billion shares. All are in tradable A form listed in Shanghai. Of the 5.2 billion tradable A, ST owns 4.2 billion, and then the domestic investors hold the remaining 1 billion, all tradable, okay? Within the H share global offer, a group of 10 cornerstone parties will buy 600 million, and each of them will buy 60 million. And they agree to a lockup, so on and so forth. In order to facilitate an over-allocation, the global coordinator borrows 300 million shares from the cornerstone parties. In addition to the offering of 2 billion of H, a further 200 million shares originally held by ST are converted from domestic tradable A into H and transferred to China's NSSF. You are aware what this is all about, right? You know what NSSF stands for? National Social Security Fund. This is what they have sometimes done in the past when a mainland Chinese company comes to the Hong Kong market and they raise additional capital in H shares. They would not only raise new money, but they would take a part of their existing A shares, tradable A shares, and convert that into H. Now, this is something that we haven't mentioned elsewhere, perhaps. They would convert it into H, and they would, I guess, donate that to the National Social Security Fund. So it is, again, another example of how one pocket and the other pocket. This company was owned by the government, so the ownership changes from one part of the government now to another part of the government, which is the NSSF. So you need to calculate the percentage of equity retained by ST immediately after. Now, again, it's the same old stuff. The denominator, like I said, please get that right. If you get that wrong, it's all wrong. So the old number of shares plus the new number of shares, these are H shares. What's the 300? This is the green shoe. They tell you that down here, okay? So every time you see a little footnote, please do read it. Without this, you can't work with it. So there will be a over allocation, and it's new issue. Okay, so Paul does make it quite obvious. It's new issue of 300. So if you don't have this number, your answer will be wrong, and a lot of the parts that follow will be wrong too. And then Well, what has ST actually lost? Well, this is what they had to begin with. They are donating this to the NSSF and okay. Very good. Excellent. Okay. So you are paying attention. You see, you have to read this last sentence here in order to insert this little 30 here, because they will not only donate 200, they're going to donate 15% of 200. So they end up with just around 53%. Okay. It's tricky, but it's fun. Assume the NSSF holds 208 million tradable A. Oh, they already had some before. They had some tradable A. So this 208 million would be part of that 1 billion, I assume. It has to be. Furthermore, it arranges to buy 80 million H from the global offers. Okay, so there's lots of things happening. So first they had, this is what they already had. They're going to buy another 80. And if the green shoe is exercised, they will be buying another 15%. They get given 200 from the government, and there is a 15% over allocation on that 200. So you add all this up, whereas this one doesn't change. Okay, it's just exactly the number above. So that's the answer. Okay. What is the market capitalization value of the outstanding stock after full green shoe exercise? Again, there's a footnote. So based on share price of 11.50 for H shares, and then 13.50 for the A, I think you're going to need some kind of FX conversion factor, aren't you? Oh, here it is. Yeah. So this is the conversion rate. So all you do is you multiply the share price, so the renminbi share price, by the renminbi shares, which is now decreased, and then the H. And you would need to convert this value into Hong Kong dollars by using this. Okay. Oh, this is just a question on clawback, so it's very simple. Okay, now this one, 44, question 44, part E. This is a good one, and in fact, it relates to what some of you were asking me about the idea of a reverse clawback. So you all know how when there is a lot of retail interest, that some of the allocation is moved from institutional to retail. Now, reverse clawback is the opposite. So when the subscription rate to the retail is less than 1, so you can't even sell all the shares in the retail tranche. But at the same time, when the subscription rate to the international placement tranche is greater than 1, so you need both of these conditions, because that means you have some shares in the retail tranche that you can't sell, but in the international tranche, people want more than what's available. Then that is a reverse clawback. What if in the retail tranche things are going badly, but in the institutional tranche is also going badly, what do you do then? The IPO will be failed. It can fail. I think it depends. Actually, a couple of things can happen. Under the underwriting, there is usually a number. That's what underwriters are for. If you can't sell all the shares, okay? The underwriter will have to take it up, and it will sit on their book, and they just hope that little by little they can offload it. Either that, or sometimes, yes, you just cancel it. Didn't they cancel an IPO recently? What was that company called? WeWork. Did they cancel the IPO? I think they did. Yeah, officially canceled IPO plans. Do you know what WeWork does? It's not a Chinese company. It's got nothing to do with WeChat. I'm asking. I don't know. Do you know what they do? Do you know where it came from? U.S. Right. I remember I was in South Korea in July, and I was walking around Seoul, and then suddenly I saw this building. Oh, WeWork. Oh, is that part of WeChat or something? What does this company do? But I think it's not. Okay. Now, like I said, 45 is just fact finding, more or less, and 46 as well. So this, if you have questions later, feel free to send me an email. But 47 is something that I think we can take a look at. And after that, I'm going to let you go. Okay. When we get to around 11:15. So suppose a privately owned Chinese company, CCT, is about to embark on an IPO. It is incorporated in the Cayman Islands, and we did speak about beautiful Cayman Islands earlier in the term. They plan to list on Hong Kong EX through a global offer of 1.6 billion shares. 1.2 is primary and 400 is secondary. The vendor of the secondary shares is the controller. So it's not everybody selling from this 400, just the major shareholder. And from within the total global offer, the initial placement will be 10% retail and 90% institutional. Just prior to the global offer, CCT has 4 billion ordinary shares par, and this is usually not that important. Okay. PRV is holding 3.88 billion of these, so that 400 secondary share will all come from this 3,800, 3.88, with French venture capital holding the remainder. Well, that's very little, 120 million. Additionally, PRV agrees to lend 240 million of its shares to the IPO. Now, why 240? I see. That is 15% of 1,600, is it not? So that is the over allocation. They all come from PRV. So like we were discussing earlier, there is nothing, whether it's fair or unfair. So PRV is happy and wish to sell these additional shares. Well, actually, now they're lending. GC will over-allocate. The IPO is subject to an offer price range. There is normally a range. The final offer price is $7.90 for all the shares. The subscription rate to the retail tranche initially was 20 times over. And you have to observe Hong Kong Exchange Practice Note 18. During the first 10 days of trading, GC purchased 100 million shares on market at an average price of $7.75, which is slightly below the IPO price. So it looks like this IPO was not going totally well. And there's an over allocation of 240, and they already had to buy back 100 during the first 10 days. Let's see what happens afterwards. The option grantor to the greenshoe is CCT. Okay, so in this case, it is not the major shareholder supplying the additional greenshoe shares. They are simply selling 400 million. The other 240 million over allocation will be new shares coming from the company. Okay. Just before the end of the stabilization period, GC partially exercises. Okay, so there are new shares, but only 140, not 240. And no vendor sales results. No vendor sales were ever planned because these were all provided by CCT, the company. For the purpose of on-market stabilization, state the maximum price they would buy. They would possibly, well, they normally only buy the shares if the IPO is not doing well, and they would buy it at the IPO price or below. Okay, it's what usually happens. How many shares do investors in Pool B receive? What? Okay, just half of it. Okay, so the whole retail tranche size increases to 20%, and half of that is Pool B. Calculate the percentage of equity retained by, okay, again, so old shares, new shares, over allocation. This was going to be 240, but 100 was bought back, so only 140. And then this is the shares they had, this is what they got rid of, so 65%. Okay. I think one very key point actually is this point. The option grantor, the over allocation will be covered by CCT. It will not be covered by PR, because if you don't pay attention to this, you're going to get it wrong here. You don't know who is losing the additional shares. Thank you. Yeah, exactly. Or who is going to supply the additional 240, which turned out to be 140. Okay. What is FVC's percentage share interest in CCT? What? After partial greenshoe exercise. Okay, so this is kind of like a minority shareholder. So total new number of shares is this one, so you are reusing that number. They had 120, they bought another 48, and Hmm? The answer is wrong, you said. Yeah, because they also bought this is the green shoe on 4.48. This is 15% of 48. Okay. PRV didn't generate from the funds, gross funds generated. How much of this cash do the following parties receive? CCT got some cash because of the IPO. PRV actually ended up, they paid for something. They didn't receive any cash. Okay. Is everyone okay with that? I tell you, a question like this might look complicated, but when you get more and more practice with your in-class assignments, your take-home assignments, you will get better. I'll tell you a little story, and I'll let you go. It's worth sharing. When I was a young boy, I used to have I should give you a few notes. Who was it? I used to have a teacher, and he was very good at chess. He was practically a professional chess player. Sometimes he would play on stage for money. You have people like that. And then one day he challenged me for a game of chess. But the way we played was I was sitting in front of the chessboard and I had all the pieces. For him, he was sitting with his back. He was sitting with his facing the wall. And he asked me to just tell him each time there is a move. How on earth? Wow. So I told him the moves. He didn't look at the chessboard. He closed his eyes and he played with me like that. And he still beat me. You know what I mean? Now what he was doing, why I tell you that story is, when you have a question like that, you sort of have to do what my teacher was doing. He had all the details in his mind, and he was able to figure out exactly how they relate to each other. Every single little detail. And then, so sometimes you do have to pay attention to, 12 different things happening, but you will get better at it the more exercises you do. Okay? Is that okay with everyone? All right, I better let you go. And it's very nice to see you on a Monday morning. I hope that was helpful. And remember, if you have any other questions, please feel free to let us know. Okay. Otherwise, I wish you a very good day ahead, a very good week ahead. Thank you, guys. There will be a video later on this.